In this presentation, we're going to add a draw to our financial statements with the help and use of bank feeds. In other words, we're going to see the information of the draw come out of the bank account with the use of the bank feeds, and then we're going to add that to our financial information. Time to clean up the bookkeeping mess with Sage Business Cloud Accounting. Here we are on the Get Great Guitars Company summary page. Within Sage, we're going to be opening up our financial statements, hovering over the reports, starting off with, of course, that balance sheet report. So we'll open up that balance sheet report. Once open, we're going to hover over the tab up top, right-click on it, and we will then duplicate that tab. We're going to go back to the tab to the left then. Going to do the same thing for the P&L, profit and loss income statement, hovering over in the report, and then go into the profit and loss so that we can then open up that report. That's how you open it up. And then we're gonna duplicate the tab, go to the tab up top, right click on it, and duplicate that tab. So if we go back to the balance sheet, just checking the dates, we're at 12/31/20, that'll work. Back to the P&L to check the dates, we're at the 4/1. I'm going to start at the beginning of April because that's where our information will be starting for the second month. I'm just going to take it to the end of the year. That'll be good. So that looks good. Let's go back to the first tab then. We're going to go to the banking section within the ribbon. And we're going to be uploading or taking a look at those bank fee transactions where we have four of them left here on the bank fee transactions. And we're going to say that this is going to be a draw. So money came out. We don't know what it's for. We don't have any reference to it. It was just money that was taken out of the system. So remember, there's two things that can happen when money's taken out of the system. One is that money was taken out and it was used for the business in some way. So money was taken out and then it was spent in some kind of business related way, in which case you would think it would be an expense of some kind. Now that's a problem because it's not really a problem, but it's harder for us to track because we don't know what the expense was. We would like to have the expenses. You really want to have your expenses from a tax perspective at least to be trackable, auditable, so that if the IRS comes back and asks you about them, then you can easily say, here's the audit trail for it. And it's easier to do that with electronic payments. So if you have the electronic payments on something that's a good, legitimate business expense that you want to deduct on, your taxes, then it's easier. It's nicer to have an audit trail. Now you could have the receipts and whatnot and add that, and it would be okay too. But it's going to be a little bit more difficult to pull that information up, and it's also a little bit more difficult if you're working with a bookkeeper. The bookkeeper doesn't know where, of course, the money was spent strictly from the bank feed information. So what we would like to do then, and so last time that's what we did. We put it to miscellaneous expense, assuming that it was a business-related item that we didn't know about. So if it's not always going to be a draw that's taken out, then there's always going to be a question. Every time there's money taken out, we got to ask and say, well, what is this for? What was that for? And put that in the system. So what we would like to do, and what we'll do this time, is the other method where we would say, look, everything that's business related is either paid with a check, a credit card, or a electronic transfer directly out of the bank, and therefore we can see who it's going to and have that kind of information within the bank feed, so we can tie that out directly to the proper account once we know, who that vendor is and what they typically do. And then anything that's drawn out for cash would be money that would be used for the owner. The owner took the money out for personal use. And that's what we would expect to see in a healthy business, right? In a healthy business, we would expect the money to be going up because the business is doing well. And then periodically, the owner takes the money out of the business for their personal use. And whenever the money goes up, that's that'll typically be income from the customers, hopefully. And the any expense that isn't cash that's going out of the system is going to be for typically business-related expense that will not be just cash coming out, but will be paid electronically or by check or some trackable way, which is good for the audit trail. So we want that, and then we want the anything that's cash that comes out of the business that would go. We can assume that goes to the owner. It would be owner taking money out of the profitable business and spending it then on personal use. That's what we would like to kind of see, and that's what we'll apply this time. So I'm going to say that this is going to be we could put the owner, but we don't really need to because it's not really a vendor. So I'll keep it blank here, and I'm going to say it's going to be a draw. I'm going to say it's a electronic transfer, and this time it's not going to be going to miscellaneous. The key is it's going to be going to some kind of equity account. And I'm going to see if they have a draw. Let's see what they got here. Let's hit the old drop down, see what we got. Yeah, so they have one. It's a 3930. It's going to be the owner's draw. So the owner draw, there it is. So what's this going to do when we record this? It's going to be decreasing the checking account. The other side's not going to be going to the income statement, but rather to an equity section on the balance sheet, that being in the account called draws for account number 3930. Let's go ahead and create that and then check it out by hitting the create button, and then we'll go to the balance sheet to check it out. We're going to recalculate the balance sheet. We know the checking account's going to go down. That's fairly straightforward. I won't go into that again. The other side is going to be down here. Notice it's on the draw. So the point is it's in the equity section. Different companies may sort these equity accounts in a different way. Like they might group together the contributions and the draws together possibly. And then the net income might be called retained earnings or something that's going to roll into that the retained earnings are going to roll into. But the bottom line is that it needs to be in the equity rather than going through the income statement. This amount here is the amount that's going through the income statement rolling into the balance sheet. This amount here is from the investments by the company, by the owner into the company, and this is the amount that the owner took out. We would hope at some point that this amount that's being taken out of the company will be greater than the investments that are going into the company, because the profits, hopefully at some point in time, will be positive and positively rolling in. Due to the profits of the company, the owners hopefully will have more draws than contributions to the company at some point. That's what we would expect in a longer lived or healthy type of organization over time. So no effect then on the income statement at this point in time, and that's going to be it for now. Let's get out of here.